If the stock market stopped printing prices for 10 years, could you still sleep well owning what you own?
Right. And if you couldn't sell anything for a decade, would the income still show up on time?
Welcome to Capital Allocation Lab Calm, audio-first lessons that turn classic investing ideas into practical decisions for long-term owners.
Yeah, our mission on this show is straightforward. We want to revisit the great historical books and core financial ideas.
And translate them into durable judgment frameworks that you can actually use today.
Exactly. We are not here to offer hype, and we definitely do not provide trading signals. We are looking for timeless principles.
Before we jump in, subscribe and like to support more educational episodes. It takes just a second, and it really helps us bring these concepts to you.
And just a quick reminder for you listening, educational content only, not individualized investment, legal, tax, or accounting advice.
So today we are diving into a topic that might sound like it belongs in a museum.
It really does sound old-fashioned at first.
Right, but the reality is, it is staring you in the face every time you look at the modern market. We are analyzing classic railroad bonds and public utility bonds.
Because the goal is to understand what those seemingly antique industries teach us about evaluating any capital-intensive, fixed-charge business.
Which leads us directly to the modern equivalent of building the railroad network.
AI infrastructure.
Exactly. We are talking about data centers, power generation, chips, and the massive piles of debt and long-term contracts required to bring them online.
The parallels are actually stunning once you know what to look for.
So we have our mission. We are going to look at what makes a fixed value security genuinely safe, focusing on the downside.
And we will translate that directly into the AI infrastructure boom you are seeing today.
Let us start with the first major hurdle any investor faces when looking at these massive asset-heavy businesses.
The data trap.
Yeah, the data trap. If you look at an old railroad report, it's completely overwhelming. You are bombarded with statistics.
It's not just revenue and expenses. It is track miles, tons of freight hauled, daily car loadings.
Fuel cost per locomotive mile.
Right. It feels like you need an advanced degree in logistics just to read the first page.
But that abundance of data is actually a psychological trap, isn't it?
Absolutely. When a business generates mountains of statistics, it seduces the analyst. You start believing that the correct investment decision requires dissecting every single operational metric.
Right.
But if you are buying a high-grade bond, a fixed-value investment, your core job should actually be minimalist.
Because as a bondholder, you are buying survival, not growth. I think that is a crucial mental shift for anyone listening who usually buys stocks.
Oh, definitely.
When you buy a stock, you want all that data because you're trying to predict massive upside. But a bond is just a contract with a capped reward.
Precisely. If you lend your money at a 5% coupon, you do not magically get paid 10% just because the management team executed a brilliant turnaround strategy.
Or because traffic doubled.
Exactly. Your absolute best case scenario is that you get your 5% coupon and eventually you get your principal back. The entire game is simply avoiding permanent loss.
So the analytical effort has to match the payoff profile. You shouldn't be asked to do equity-level prediction for bond-level pay.
Which happens all the time.
Right. If finding a safe bond requires you to accurately forecast a subtle, multi-year shift in train load efficiency versus a changing mix of lumber and coal traffic, you are playing the wrong game.
You are taking on all the analytical burden of a stock picker, but accepting the capped upside of a lender. The primary focus for a bond investor is simply a demonstrated margin of safety.
You want to see historical numbers proving the company can absorb a tremendous amount of bad luck and still write the interest check.
Which brings us to the three pillars of that margin of safety for high-grade bonds. Let's walk through these slowly so they really stick.
Good idea.
The first pillar is coverage. You need concrete evidence that the company's earnings comfortably and repeatedly cover its fixed charges.
Okay, coverage. And the second?
The second pillar is the equity cushion. You need evidence that the underlying value of the business stands well above its total debt. The equity acts as the shock absorber for the enterprise.
Makes sense. And the third pillar is a bit softer, but just as vital, right?
Yes, a qualitative check. You need to look at the enterprise and conclude that it is likely to continue operating successfully into the future, making failure highly unlikely.
I really love the phrase highly unlikely because it keeps us grounded.
Yeah.
We are not buying certainty because certainty does not exist in financial markets.
We are buying a very high probability of survival.
Okay, let's dig into that first pillar, coverage. In a capital-intensive business like a railroad, what exactly counts as a fixed charge? My brain immediately just goes to the interest payments on the bonds.
Interest on the debt is the most obvious piece, sure. But in the railroad industry, fixed charges encompass a lot more.
Like what?
You have to include rent for leased lines. Many railroads did not actually own every mile of track they operated on. They leased critical segments. You also have joint facility rents, where multiple companies share a massive terminal or a switching yard.
And the source material mentions something called hire of equipment, which sounds fascinating.
That is when a railroad pays to use rail cars or locomotives that belong to someone else. It sits in a gray area. It isn't quite as immovable as a legal bond coupon, but in the short run, it is a mandatory cash outflow.
Because if you need the cars to move the freight, you have to pay the daily fee.
Exactly. During a sudden economic downturn, that rent behaves exactly like a fixed charge.
Let me translate that for our listener today. That is essentially an operating lease. Think about a modern airline leasing its planes, a retailer leasing storefronts, or a tech company leasing server space in a data center.
The terminology has evolved from hire of equipment to operating leases, but the economic reality of a mandatory recurring cash drain is identical.
The labels change, but the math does not. Now, let's look at the flip side of the income statement. We've defined the fixed charges pulling cash out, but we also have to watch out for a trap on the income side.
Specifically, a line item called other income.
This would be money the railroad makes that doesn't come from hauling freight or passengers.
Yes. A railroad might own financial assets, or it might receive dividends and interest payments from subsidiary companies it controls.
And in theory, you can use that other income to offset the interest the railroad has to pay.
In theory. But you have to rank those income streams by their dependability.
Because interest received from holding a portfolio of high-quality government bonds is incredibly dependable.
Right.
But a special one-time cash dividend extracted from a struggling subsidiary is not. It might make this year's earnings look fantastic, but you can't rely on it to support a 20-year bond coupon.
Which means we need a rigorous way to test this coverage. Most people hear interest coverage ratio and assume it is a single, simple calculation. You take the earnings and you divide by the interest.
But railroad income statements have multiple layers. You have operating income, then income after rents, then you add the other income.
So how do we find a coverage number we can actually trust?
By using a double check method.
Exactly. You compute the coverage ratio in two entirely distinct ways, using different layers of the income statement. Then you look at both results and base your margin of safety on whichever number is more conservative.
Let's walk through those two tests. I want to make sure the math is crystal clear for you listening, so let's take it step by step.
Sounds good. Test A asks this question: how many times did the gross income cover the fixed charges?
Okay.
In railroad accounting, gross income is your operating income minus the rents, plus that other income we just talked about.
So gross income is the total pool of money available to pay the debt after the trains have run and the rents are paid.
Yes.
And to find the fixed charges for test A, the formula is gross income minus net income.
That is correct. Net income is the absolute bottom line, the residual cash left over for the stock dividends. So logically, if you take the gross income pool and subtract what is left at the very end, the missing money in the middle is the amount absorbed by fixed charges.
And for test A, you divide the gross income by those fixed charges.
Now for the second method. Test B starts higher up on the income statement.
How so?
Test B asks, how many times did the railway operating income cover the net deductions? Railway operating income is just the pure profit from running the trains before you deal with any rents or other income layers.
And the net deductions are calculated as the railway operating income minus the net income.
Right. Once you have those two numbers, test B is simply the railway operating income divided by those net deductions.
Let's bring this to life. We are going to build a very simple toy railroad. We will run 3 different scenarios to show how these layers can completely alter your perception of safety.
Scenario 1 is the baseline. Let's say our toy railroad generates a clean 100 in railway operating income.
Got it. 100.
It has 10 in rent obligations, so the income drops to 90. But it also brings in 10 in other income. That brings our gross income back up to 100.
And at the very bottom line, the net income left for dividends is 60.
Let's run test A. First, find the fixed charges. Gross income is 100 minus the net income of 60. That leaves 40 in fixed charges.
So we divide the gross income of 100 by the fixed charges of 40.
And we get a coverage ratio of 2.5 times.
Now, test B. We need the net deductions. Operating income is 100 minus the net income of 60. That leaves 40.
We divide the operating income of 100 by the net deductions of 40, and we also get 2.5 times.
In a simple, clean corporate structure, both tests harmonize. They both tell you the debt burden is covered 2.5 times over.
But the real world is rarely that clean. Let's move to scenario 2. This railroad relies heavily on rented track and equipment. We start with the same 100 in operating income.
Okay.
But because of massive rental fees, the income plummets to just 60 after rents. It pulls in 10 in other income, bringing the gross income to 70. The final net income at the bottom is 40.
Running test Quain. A gross income of 70 minus net income of 40 means our fixed charges are 30. We divide the gross income of 70 by the fixed charges of 30, resulting in a coverage ratio of 2.33 times.
That still looks reasonably healthy.
But let's see what test B reveals. Operating income is 100. We subtract the net income of 40, giving us net deductions of 60.
And when we divide the operating income of 100 by those 60 in deductions, the coverage ratio drops to 1.66 times.
Test B exposes the vulnerability. The heavy reliance on rents makes the structure much more fragile than Test A suggested. As a bond investor, you must adopt the 1.66 times figure as your reality.
Exactly. Okay, scenario 3. This is the danger of massive other income. The railroad earns 100 in operating income. It owns its tracks, so there are 0 rents. It stays at 100.
No rents.
But it receives a massive one-time dividend from a subsidiary of 60. So gross income inflates to 160. The final net income is 80.
Let's do the math on Test A. Gross income of 160 minus net income of 80 gives us fixed charges of 80. We divide 160 by 80, and we get a coverage ratio of 2.0 times.
And Test B, operating income is 100 minus the net income of 80, leaving net deductions of 20.
Divide the 100 in operating income by the 20 in deductions, and suddenly you have a massive coverage ratio of 5.0 times.
Here, Test A is the conservative choice at 2.0 times. Test B is dangerously misleading because it allows that giant, possibly unrepeatable chunk of other income to make the underlying operations look wildly robust.
That double check is a fantastic tool. It proves that different income statement layers can completely warp your perception of risk. And there's another trap hidden in other income that you need to watch out for.
Internal offsets.
Right.
This happens in complex holding companies. A parent railroad might record interest received from an affiliate as other income, but somewhere else on the consolidated statement, that same affiliate is recording the payment as interest paid.
It is the corporate equivalent of taking a $20 bill out of your left pocket, putting it into your right pocket, and telling the bank your income just doubled.
So both the income and the expenses look artificially huge.
If you have the data, you should net out those internal loops. But the broader lesson for you listening is simpler. Whenever you see unusually large other income, treat it with intense skepticism.
Do not let a flattering spreadsheet put you to sleep. A margin of safety is supposed to keep you awake to the real risks.
Which perfectly transitions us to one of the most brilliant, practical concepts in this entire framework. If you really want to know if a company's earnings are real, you have to look at maintenance.
Maintenance is the economic truth serum for a capital-intensive business. Think about a physical railroad. You have wooden ties rotting, steel rails wearing down under thousands of tons of friction, bridges facing weather erosion.
And locomotives that require constant mechanical overhauls.
Exactly. If the management team wants to make this quarter's profits look spectacular, they have a very easy lever to pull. They just stop fixing things.
They defer the track replacements and delay the locomotive servicing. The cash stays in the bank, the earnings spike, and the bondholders think everything is wonderful.
But they are borrowing from the future. The physical reality of the assets cannot be ignored forever. Eventually, that deferred maintenance manifests as slower train speeds, terrible service, derailed freight, or a sudden catastrophic bill for total replacements.
For a bondholder whose entire investment relies on the system surviving for decades, artificial earnings created by starving the property are terrifying.
So how do we spot the lie? How do we check if the earnings are genuine or inflated by neglect?
We use a percentage of revenue benchmark for the maintenance ratio. Historically, analysts observed that a healthy, well-run railroad typically needed to spend a certain percentage of its gross revenues just to keep the system intact.
During certain eras, a rough rule of thumb was about 1/3 of gross revenues.
Let's walk through a concrete example to see how an investor would adjust the numbers. Imagine you are evaluating a railroad bond. The company reports gross revenues of $1,000.
Okay.
On their income statement, they show maintenance spending of $280. That is 28% of their gross revenue.
But let's assume your research tells you a conservative, safe benchmark for this type of operation should be 32%. If they were maintaining the property to your conservative standards, they should have spent 320, not 280.
So there is a shortfall. The management underspent by 40.
As a conservative bond investor, you do not ignore that shortfall. You treat that 40 as a phantom expense that should have been paid. You subtract that 40 from their reported earnings, and then you completely recompute your coverage ratios using the lower adjusted earnings number.
That is a phenomenal stress test. It immediately exposes a bond that only looks safe because management was cannibalizing the company's future. And you don't even need to know the exact perfect amount of maintenance required.
You just apply a slightly harsher standard and ask, if things were a bit tougher, would my bond still be okay?
It embodies the core philosophy. A margin of safety must survive conservative assumptions. And we apply that same skepticism to the dividend maneuvers we discussed earlier.
If a railroad abruptly pulls massive accumulated profits out of its subsidiaries just to prop up its own coverage ratios for a year, you strip those one-time spikes out of your calculations.
But what if it goes the other way? What if a company's massively overspending on maintenance, making their earnings look artificially depressed?
That introduces a crucial asymmetric rule of bond analysis. If you find hidden strength like overmaintenance or subsidiaries hoarding cash instead of paying dividends, you can view that as extra unstated cushion.
But you must never use optimistic adjustments to flip a no into a yes.
You only use conservative adjustments to turn a yes into a stronger yes.
That makes perfect sense for someone trying to protect their downside. Up to this point, we have been talking about high-grade bonds where the company is generally healthy and we are just verifying the cushion.
But what happens when the math starts falling apart? What happens when you are looking at distressed bonds?
The entire analytical framework shifts gears. When solvency is no longer assured, the broad coverage ratios are no longer enough. The work morphs into restructuring analysis.
You have to start obsessing over the specific operational details, the exact nature of the competitive threats, and the precise legal hierarchy of the debt.
Let's start with the operations, specifically the traffic. In the golden age of railroads, there was a widespread belief that diversification was the ultimate safety net. Analysts favored railroads that hauled light traffic.
Smaller shipments, highly varied manufactured goods, high-rate freight spread across many different industries.
It sounds incredibly logical, doesn't it?
Mm.
We were all taught that diversification reduces risk.
But the railroad industry experienced a brutal reality check regarding traffic. That highly profitable, diversified light traffic turned out to be the exact freight that was easiest for a new competitor to steal.
You are talking about the rise of the trucking industry.
Precisely. Trucks could easily take a small load of manufactured goods door to door much faster than a train could. The safe, diversified traffic evaporated.
Meanwhile, the unglamorous railroads that analysts had penalized for being too concentrated, the ones hauling millions of tons of bulk coal or iron ore, remained surprisingly resilient.
A fleet of trucks simply cannot compete with a heavy rail line when it comes to moving bulk commodities efficiently.
That shatters the assumption that diversification equals safety. It proves you have to understand the specific competitive vulnerabilities of the revenue stream. A technological shift can wipe out your stable customer base overnight.
Which is why relying on traffic forecasts to justify a bond purchase is so dangerous. For an investment-grade bond, traffic analysis should only be a cautionary overlay.
The foundation of your safety must be the financial margin of safety already demonstrated in the historical numbers, not a fragile prediction about future logistics trends.
And when a railroad is struggling, analysts tend to dig deeper into the efficiency metrics. They look at the operating ratio, the average train load weight, fuel consumption per ton mile.
Is that helpful for a distress bond?
It can provide diagnostic clues, but it frequently becomes an analytical trap. The danger is overlapping metrics. Many of these efficiency statistics are just different ways of measuring the exact same underlying operational reality.
If you build a model that incorporates 5 different efficiency metrics and they all point to the same structural advantage, you might accidentally count the same fact 5 times.
So you drastically overweight a single positive trait, fooling yourself into thinking you have discovered 5 distinct reasons the company will survive.
It is a psychological error. The analyst starts to believe their conclusion is profoundly robust simply because their spreadsheet is long and complicated.
We use those metrics to ask questions: why is the operating ratio so poor? Is this excellent fuel efficiency sustainable? Or is it a byproduct of running trains dangerously heavy and under-maintaining the track?
And let's say the railroad really is wildly inefficient. From an equity perspective, a turnaround investor might look at that and see a massive opportunity for a new CEO to cut costs and double the stock price.
But a bond investor must return to the primary question, does this bond have enough existing cushion to survive if the turnaround completely fails? We do not get paid for the upside of a successful restructuring.
If the business continues to deteriorate, the legal structure of the debt becomes the only thing that matters. In a healthy company with massive earnings, the difference between a senior secured bond and a junior unsecured bond might feel academic. Everyone is getting paid.
But in distress, the legal claims are the battlefield. You need to understand exactly what assets are pledged to your specific bond and where your claim sits in the hierarchy. This is where concepts like underlying bonds and divisional liens become critical.
Walk me through what a divisional lien actually means in a restructuring scenario.
Imagine a massive transcontinental railroad system going bankrupt. The entire company cannot pay its debts. But one specific bond might be a divisional lien secured exclusively by a 200-mile stretch of track that connects two major industrial hubs.
Okay.
During the bankruptcy reorganization, the courts and the creditors will analyze that specific 200-mile segment independently. If that specific track is highly profitable and essential to the network, the bonds secured by it will fare much better than the general debt of the system.
You essentially have to evaluate a mini business within the failing empire.
Yes, you transition from a financial analyst to a combination of a legal scholar and an operational auditor. It is incredibly labor-intensive.
Which brings us to an incredibly vital rule of thumb for the everyday investor listening to this. If you are buying a bond for safety and income, and you suddenly realize you need to hire a bankruptcy lawyer and consult a regional traffic density chart just to figure out if you will get your principal back.
You are no longer holding a sleep well bond. You have wandered into distressed speculation.
Let's pivot to an industry that is universally viewed as the ultimate sleep well investment, public utilities. People treat utility bonds as if they are practically government treasury notes.
Historically, they have been safer than industrial companies because the core business model is inherently more stable. But the critical lesson from the classic texts is that utility stability is relative. It is not absolute.
Let's define the terms. From a strict investment perspective, what exactly qualifies as a public utility?
A true utility supplies an essential service to the general public. We are talking about electricity, gas distribution, telephone networks, and water systems.
Crucially, they usually operate under a legal franchise, effectively granting them a monopoly in their region.
In exchange for that monopoly, they are subject to strict ongoing regulation by a government commission.
And that regulation includes a legal framework designed to ensure the utility can charge rates sufficient to earn a fair return on the capital they have invested in building the infrastructure.
The regulator is effectively baked into the business model. You have an indispensable service, broad demand, and a legal right to profitability.
It sounds bulletproof. Where are the cracks?
The cracks appear because regulated does not mean risk-free. You are essentially trading competitive market risk for regulatory and political risk.
Right. If inflation skyrockets and the cost of coal or labor surges, the utility cannot simply raise prices the next day. They have to petition the regulatory commission.
And if the commission delays the rate increase for political reasons, the utilities' margins collapse. Furthermore, even utilities face technological substitution. Think of landline telephones being decimated by cellular networks.
You cannot assume immunity just because the government is involved, but there is an even more insidious danger with utilities, and it has to do with marketing. During massive economic booms, Wall Street loves to exploit the comforting aura of the word utility.
The seduction of the label. Promoters and bankers realized that investors would accept much higher debt loads and demand much lower interest rates if a business was labeled a public utility.
So they started stretching the definition. They would create hybrid corporations. They might own a genuine regulated local power grid, but they would attach it to a highly competitive volatile business, like ice manufacturing, cold storage facilities, or streetcar networks.
The deception was elegant and devastating. They were borrowing money based on the pristine reputation of a utility, but they were deploying that capital into the risky operations of an industrial company.
If the industrial side of the business suffered a downturn, the enormous debt load, which was mathematically completely inappropriate for a volatile business, would crush the entire enterprise.
The lesson for you listening is clear. You must dissect the actual cash flows. Never let a comforting label bypass your critical analysis. If a company claims to be a utility, you have to ask which specific percentage of this revenue is actually protected by a regulated monopoly and which percentage is exposed to brutal open market competition.
And we must apply intense commodity skepticism as well. Sometimes commodity extraction businesses like natural gas producers were marketed with utility-like terminology.
But digging a commodity out of the ground is subject to vicious global price cycles, supply gluts, and demand shocks.
A pipeline moving the gas might have stable utility economics, but the well producing the gas absolutely does not. Treat pipes and wires as stable, treat commodity production with deep suspicion.
Now, let's look closely at how the math in these offering documents can be manipulated. There are two classic presentation tricks used to make new bonds appear far safer than the underlying economics justify.
The first one is a structural manipulation. Let's call it the after prior deductions calculation trick. Walk me through how a promoter uses this to fool an investor.
It typically happens in holding company structures. The enterprise already has senior debt, which requires fixed senior interest payments. Now they want to sell a brand new layer of junior bonds to the public. To convince you the new junior bonds are safe, they change the math.
Instead of calculating the total coverage for the whole company, they isolate the new bonds.
Yes. They say, let's pay the senior charges first. Look at the cash remaining. See? That remaining cash easily covers the interest on your new junior bond. It sounds perfectly logical to a layman. It mimics the idea of residual cash flow.
Let's prove why that is so dangerous with some hard numbers. Imagine the entire enterprise generates 100 in earnings available for fixed charges. The existing senior bonds require 60 in interest. The new junior bonds they're trying to sell will require 20 in interest.
So the total fixed charges for the enterprise are 60 plus 20, which equals 80. If we do the honest math, the true coverage ratio is the total earnings of 100 divided by the total charges of 80. That is a coverage ratio of 1.25 times.
1.25 times is a razor-thin margin of safety. If earnings drop by just 21%, the company defaults. It is a highly risky situation.
Now watch the presentation trick. The promoter takes the 100 in earnings and subtracts the senior charges of 60 first. They announce we have 40 remaining in earnings applicable to the junior bonds. Then they divide that 40 by the junior interest requirement of 20.
40 divided by 20 is 2.0 times coverage.
Suddenly, the marketing brochure claims your new junior bond is comfortably covered 2 times over. But think about the logical absurdity of this math. The true overall enterprise coverage is a fragile 1.25 times. Yet the trick makes the junior subordinated bond look mathematically safer than the company as a whole.
It violates basic common sense. A junior claim cannot possibly be safer than the senior claims above it. The takeaway for anyone analyzing a capital structure is ironclad always compute coverage using the total fixed charges of the entire enterprise.
The second presentation trick is perhaps the most destructive force in utility investing, ignoring depreciation. This is where the capital intensity of the business comes back to bite the unwary investor.
Let's clarify why depreciation matters so much here. In a software company, depreciation might just be an accounting fiction spreading out the cost of office laptops. But in a utility, it is a physical reality.
Assets physically degrade. Wooden utility poles rot in the ground. Copper wire oxidizes. Massive steel turbines wear out. Power plants reach the end of their operational lifespan.
A utility must constantly spend real cash to replace these components just to keep the lights on. If a company ignores depreciation when calculating its earnings, it is essentially pretending that its massive infrastructure is magically immortal and free to maintain.
So the offering document will highlight a huge earnings number, but they haven't deducted the economic cost of replacing the rotting poles. How do they get away with this in the marketing materials?
They often point to a minimum required depreciation charge buried in the bond indenture, which was negotiated to be artificially low. They proudly state they met the legal requirement, masking the fact that the legal requirement is completely disconnected from economic reality.
Let's run the numbers on a stylized example from the source material to see how massive this distortion can be. Imagine a hybrid utility company. The offering document boasts a gross revenue of $3,361,000. They present a line item called net before depreciation, showing $969,000 in earnings.
They subtract a few minor prior charges and proudly declare to the public that the remaining income covers the bond interest roughly 2.7 times.
2.7 times coverage sounds incredibly safe for a utility. You would buy that bond and sleep like a baby.
But let's inject economic reality. Let's assume the standard realistic depreciation reserve for this specific type of utility infrastructure should be About 15% of gross revenue. 15% of that 3,361,000 gross revenue is roughly 500,000.
So the real economic cost of the assets degrading is
We
$500,000.
must deduct that. We take their net before depreciation of 969,000 and subtract the 500,000 in real depreciation expense. The actual net earnings plummet to 469,000.
And when you take that much smaller, 469,000, and calculate the coverage against the total interest burden,
The coverage ratio crashes to roughly 1.0 times.
wow. A bond that was marketed as having a luxurious 2.7 times cushion is actually operating with zero margin of safety. It is earning exactly enough to pay the interest with nothing left over. One minor recession, one spike in labor costs, and the bond defaults.
That is why the math matters. The failure to account for depreciation didn't just tweak the numbers. It fundamentally disguised a high-risk speculation as a conservative investment.
Before we leave the accounting tricks, let's briefly touch on taxes. Should you listening calculate these coverage ratios using pre-tax or after-tax earnings?
From a strict conceptual standpoint, interest is a pre-tax expense. You pay the interest to the bondholders before the government calculates your taxable income. So technically, the earnings available for interest are pre-tax earnings.
But most financial platforms and screeners show net income after tax. Do I need to manually rebuild the pre-tax income statement for every bond?
In practice, no. While elaborate corporate structures sometimes require digging, generally using the readily available after-tax earnings number is perfectly acceptable because it actually understates the coverage. It makes the ratio look worse than it is, which aligns perfectly with our goal of being deeply conservative. Do not let complex tax adjustments distract you from the core analysis. Complexity is not a substitute for accuracy.
We have spent a lot of time in the 1930s looking at railroads and utilities. Let's build the bridge to the present day. We are going to apply every single framework we just discussed to the modern AI infrastructure boom. Let's dive deep into the 10 specific similarities between the historical network builds and the massive data center expansion happening right now.
Let's start with similarity number 1, the narrative of inevitability. Think about how people viewed railroads in the 19th century. They weren't just a business. They were the physical rewiring of the entire economy. They opened continents, slashed transportation costs, and birthed entirely new industries.
The feeling was that if a city didn't get a railroad stop, it would die. You had to participate.
And that profound narrative attracts tidal waves of capital on incredibly generous terms. Investors are so terrified of missing the paradigm shift that they stop asking hard questions about margins of safety. In the railroad era, capital blindly chased track mileage. Today, with AI, capital is blindly chasing data center capacity, power interconnects, and massive clusters of GPUs. The psychological frenzy is identical.
Similarity number 2, brutal capital intensity. These are not software businesses you can build in a garage with a laptop.
The physical footprint is staggering. Railroads required buying massive corridors of land, moving millions of tons of earth for grading, blasting tunnels, laying steel, and buying fleets of locomotives. Today, an AI data center requires securing hundreds of acres of prime real estate, building massive concrete shells, installing industrial-scale water cooling towers, acquiring specialized electrical substations, and outfitting them with tens of thousands of hyper-expensive servers. The upfront cash burn is monumental.
Which guarantees similarity number 3, fixed charges as the fulcrum. You cannot fund that level of physical construction purely with equity. You have to borrow.
And when you finance long-lived physical assets with debt or rigid contracts, you create obligations that are utterly blind to the business cycle. We discuss railroad bond interest and leased line rents. The modern AI infrastructure equivalent includes bond interest, massive operating leases for facility space, and take-or-pay commitments.
Explain how a take-or-pay contract works in this context.
An AI data center consumes an astronomical amount of electricity. To convince a power company to build the necessary transmission lines, the data center operator might sign a 10-year take-or-pay contract. They legally commit to paying for a massive baseline of electricity every single month, whether they actually run the servers or not. It is an immovable fixed charge. If AI demand dips for 2 years, that power bill still arrives every 30 days.
That is terrifying if the revenue drops. Which brings us to similarity number 4. And this is where the math we just learned saves you accounting flatters coverage.
We just spent 10 minutes proving why ignoring depreciation in a 1930s utility bond was a recipe for disaster. The modern manifestation of that exact same error is focusing exclusively on EBITDA while ignoring refresh capital expenditures.
EBITDA is earnings before interest, taxes, depreciation, and amortization. It is Wall Street's favorite proxy for cash flow. But why is it deceptive for an AI data center?
Because a cutting-edge AI server does not last 40 years like a steel rail line. The technological obsolescence cycle is brutal. A cluster of advanced chips might be effectively obsolete in 3 to 4 years as faster, more energy-efficient architectures are released.
So if you just add the depreciation back into the earnings and call it EBITDA, you are pretending those servers will last forever. But in reality, you are going to have to spend massive amounts of real cash in just a few years to replace them, or your customers will leave for a faster competitor. That replacement cash is your refresh capex.
Let's run a modern math example to make this painfully clear. Suppose you are analyzing an AI infrastructure company. They proudly report an EBITDA of 200. Their annual interest expense is 80. The casual analyst looks at that and says, great, 200 divided by 80 means EBITDA covers interest 2.5 times.
It's safe. But let's dig deeper into the actual cash obligations. Suppose this company also has mandatory lease payments of 40 on their buildings, and to keep their server racks from becoming obsolete garbage, they absolutely must spend 120 this year in refresh capex.
Let's calculate the true cash margin of safety. We start with the EBITDA of 200, but we must immediately subtract the 120 in mandatory refresh capex. That leaves us with only 80 in sustainable prefixed charge cash flow.
And what are the total fixed charges? The interest is 80 plus the mandatory leases of 40. The total fixed burden is 120.
We divide our actual available cash of 80 by our total fixed burden of 120. The true cash coverage ratio is 0.67 times.
It is not covering the charges at all. They're bleeding cash.
The 2.5 times EBITDA coverage ratio was a mirage masking a severe cash shortfall. The label changed from ignoring depreciation to ignoring capex, but the destruction of capital is exactly the same.
That is profound. Similarity number 5 is closely related maintenance discipline.
In a cash crunch, a railroad manager defers track maintenance. In a cash crunch, a data center manager delays server upgrades, stretches the lifespan of cooling equipment, or underinvests in backup power redundancy. It artificially inflates near-term cash flow, but it drastically degrades the long-term competitive position of the facility.
Similarity number 6. Competitive substitution. The railroads thought their traffic was permanent until the highways were built and the trucks arrived. What is the equivalent for AI infrastructure?
Technological shifts can strand assets. A new breakthrough in chip architecture might make current cooling designs wildly inefficient. Massive price wars between the major cloud providers could crush the profit margins of independent data centers. Or algorithmic improvements might drastically reduce the sheer volume of brute force compute required to train a model, shrinking total demand.
Which sets the stage for similarity number 7, overbuilding.
When capital is cheap and the narrative is intoxicating, humanity always overbuilds infrastructure. Too many competing rail lines were laid between the same cities, destroying pricing power. Today, there is a risk of massively overbuilding compute clusters based on extrapolating peak frenzy-level demand far into the future.
And an oversupply glut is a bondholder's worst nightmare, because the prices you can charge your customers collapse, but your interest payments and take-or-pay power contracts do not budge a single inch.
Similarity number 8, pseudo-stability. We talked about industrial companies borrowing the public utility label in the 1920s. Today, highly volatile technology infrastructure companies market themselves using terms like mission-critical platform or digital utility.
They want you to believe their revenues are as stable as your monthly water bill.
But they do not possess a regulated monopoly franchise. They might have signed a few multi-year contracts, but when those contracts expire, they face ruthless open market competition. You must ask, is the stability enforced by law, or is it merely an assumption based on current optimism?
Similarity number 9, specific security details.
Just as we analyze divisional liens on specific railroad tracks, you must analyze the modern legal stack. Is the debt held at the parent holding company, or is it secured directly by the physical servers in the operating subsidiary? Are there strict covenants preventing the company from taking on more debt?
In a booming market, nobody reads the covenants. In a restructuring, the covenants dictate who takes the loss.
And finally, similar to number 10, the timeless logic of the margin of safety. The specific technology changes, but the fundamental physics of corporate leverage do not.
Let's synthesize all of this into a clear, actionable framework. If you listening are looking at any fixed charge investment today, whether it is a traditional utility or a cutting-edge AI data center, here is your 8-point checklist.
Point 1, identify all fixed charges. Do not stop at the interest expense line. Hunt down the operating leases, the joint venture requirements, and the long-term take-or-pay commitments. Gather the entire burden.
Point 2, Compute the coverage ratio using the most conservative earnings measure available, and do it multiple ways. Just like the double-check tests A and B for railroads, compare an EBITDA coverage ratio against a strict cash-based coverage ratio that deducts essential capex.
Point 3, stress test that coverage. Assume a harsh economic environment. Model what happens if they have to increase maintenance spending or accelerate their equipment refresh cycle. Does the bond survive the stress?
Point 4, quantify the equity cushion. Look beneath the debt. How much actual equity capital is supporting the enterprise? How massive of a loss can the company absorb before your debt layer is even scratched?
Point 5, examine the long-term trends. Is the operating ratio improving, or are they slowly losing pricing power? Is the structure becoming more resilient or increasingly fragile?
Point 6, treat other income with extreme suspicion. Strip out one-time asset sales, special dividends, accounting maneuvers, or temporary government subsidies. You want to see core, repeatable earning power.
Point 7, understand the specific security. Know exactly where you sit in the capital structure and what specific physical assets are pledged to protect your principal.
And point 8, step back from the spreadsheets and apply qualitative judgment. Look at the business model, the competitive landscape, and the technological risks, and ask yourself, is the total failure of this enterprise highly unlikely? If the answer relies on everything going perfectly, it is not a safe bond.
That checklist bridges the gap perfectly. It strips away the modern technological jargon and forces you to confront the eternal realities of cash flow and debt.
To wrap this up, let's distill this entire deep dive into 6 final rules of thumb. Rule 1 bond analysis is survival analysis. You have capped upside. Stop trying to predict glorious growth and focus entirely on measuring the cushion against disaster.
Rule 2, keep your analysis of high-grade bonds relatively simple. Do not get lost in 50 operational metrics. Focus on the core coverage, the equity cushion, and verifying that the maintenance spending is realistic.
Rule 3, compute coverage stringently. If there are 2 ways to calculate the safety margin, adopt the worst number as your baseline reality.
Rule 4, watch for management discretion. Earnings can be manipulated through undermaintenance or irregular dividends. Normalize those figures before you trust the coverage ratio.
Rule 5, beware of comforting labels. Just because someone calls it a utility or a mission-critical platform does not mean it is immune to competition or commodity cycles.
And Rule 6, always translate depreciation into physical reality. For modern AI infrastructure, treat mandatory refresh capex as a non-negotiable cash expense before you calculate your safety margin.
I want to leave you listening with a final provocative thought. It is easy to look at the blistering pace of technological innovation and assume the old rules of finance are obsolete. But the logic of a fixed legal claim against a volatile, breathing business is a law of financial physics. It never changes. If you are lending your money, you demand a mathematical cushion. If you are relying on an exciting narrative about the future, you are speculating, not investing.
Thanks for joining us on Capital Allocation Lab.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And we want to hear from you in the comments. What concept should we tackle next? Do you want us to build a margin of safety framework for equity valuation? Should we dissect owners' earnings? Or explore the math behind dividends versus buybacks? Tell us what you need to become a better analyst. Until next time, keep your frameworks durable and your margins of safety wide.